Hi everyone, I'm Jared Levy. I wanted to welcome you back to Westwood's new strategy series where we highlight different market segments, discuss market climate, strategy, and how investors can best position themselves in each asset class. In addition to our regular panel, we'll interview Westwood's PMs to get a feel for what they're doing to generate alpha and obviously reduce or minimize risk and volatility in their respective strategies. Today's roundtable will be highlighting LargeCap and how the space is being impacted by COVID-19, obviously the current events surrounding it, and as well as the evolution of the active-passive debate, which is sort of coming to light in this climate. With me today, I've got Westwood's head of intermediary distribution, Mr. Harvey Steele. I've got a product head and CFA, Mr. Phil DeSantis, with us, and portfolio manager, Matt Lockridge. It's great to be with you, gentlemen, during this interesting time. And, you know, in my view, LargeCap, tough area to discuss and debate because it's highly efficient, lots of heavily traded names, lots of heavily covered names. You know, it's over the past 10 years, unlocking alpha has been difficult, right? And that's why a lot of passive indexes all kind of look the same. But now that markets are volatile, now that things are getting shaken up, probably a lot more, could be a lot more alpha, unlocked value inside of this space. And yet active managers really aren't getting the respect or inflows they deserve. And that said, Harvey, do you think, the passive game has changed now for LargeCap? Will we see more of a pivot? Can you go a little deeper onto this topic?
Sure. Thanks, Jared. Financial advisors across the country have been able to handle their LargeCap allocation by just allocating to an ETF broad-based index for years, particularly the S&P, and it's worked really well. What's startling, though, is if you look at the last 3 years specifically, you pick out just 6 stocks out of the S&P 500, and you get to 56% of the cumulative return over the last 3 years. And even with the sell-off that we've seen in the market, the S&P is down roughly 20% today. A couple of stocks actually hit all-time highs last week. Further, with the S&P at these levels, even down as much as it is, if you look at Q1 earnings, forward multiples, we're still at 11, 12-year highs. If you take some of these estimates that are getting thrown out there, 130, 135 for earnings, we're at 21 times forward. We haven't been that high in many folks' investment careers. So, in my opinion, advisors are going to have to start taking a look at active managers for this recovery because the world has absolutely changed. And I'll give you a few examples of that. First, there are permanent changes to industries. You look at restaurant groups, you look at entertainment, you look at airlines. That is quantifiable. You look at some of the supply chain issues that are going to impact other industries. This is well known, and an active manager can absolutely take advantage of this, whereas a passive ETF cannot. Also, over the past few weeks, we've seen these stocks experience what we'd call a COVID sugar high, where they're trading at historic high valuations. Over time, we would expect the market to normalize and these to come back down to earth. On the other side of this, there's high quality brands with stable cash flow and solid businesses that haven't participated in this recovery. Some of these names down 30 to 50% or more. And what's interesting about cap weighted indices is you actually buy more of what's gotten more expensive and less of what has gotten cheaper. Right. So instead of focusing on these values, you're moving away from them. So I think that, to your point, indexing's worked very well, but in this environment moving forward, the best managers are going to be able to beat their benchmarks.
So let me play devil's advocate for a second here. I mean, there is a bevy of focused or nuanced passive funds out there, right? Where an investor could simply maybe pivot to like a consumer staple to simplify, or a fund that maybe focuses on low vol, low beta. Is that sort of the wrong way to think about it?
Jared, those funds absolutely do exist, but consider this. Over 90% of all ETF assets are held in simple, inexpensive, cap-weighted indices. And I think the reason for it's pretty simple. First, the average retail advisor or end client doesn't really have the time or inclination to go trade through sector or factor-specific ETFs. That's exactly what they're hiring active PMs to do.
Let me bring in Phil here, as he's done a lot of work with the data surrounding active manager performance, and I think he can, glean some insight. Phil, passive funds, obviously, they've captured an enormous amount of outflows from active over the past decade. The next 10 years, obviously, going to look a lot different than the last 10. But do you think, a sideways volatile market changes the trend we've seen in terms of outflows from active? And why do you believe active should get another look here?
I do, and I want to go right at this question with the data. And it's really important for advisors to understand what is going to work when we get into down markets, whether they're falling markets or failing markets. If you look at the last 3 times, we've had an inverted yield curve, which is typically predictive of an economic recession, and we have downside volatility in the equity markets. What you will find is that the high quality factor itself significantly outperforms. Key attributes like free cash flow generations, the core true economic profits of a company significantly outperform. Companies that had strong return on equity significantly outperform. These 2 attributes alone outperform by nearly 10 to 20% over the benchmark when you look at the entire Russell 3000 universe. You look at the flip side of the equation, and you think about, would just buying cheap companies work on the downside? Would just buying cheap companies when you look at price to book work as a hedge against volatility? These factors didn't work as well. So I think the key takeaway here is understanding what you own is going to be key when you're building your portfolio in large cap. Second part of your question I want to get to, when you think about an active manager in this environment, the ability to sidestep broken companies, impaired industries, potential value traps is a significant advantage that they have the next 2 to 3 years, particularly if we enter into a winner-take-all environment where you see a large dispersion of winners and losers in the index. And I think advisors will come back to the table and rethink how they build a large cap asset allocation across their book and think about what type of active managers they want to own, high quality managers to complement the cheap beta they have in their portfolio.
Yeah. On the cheap beta, you and I both know that cheap beta is available just about anywhere on the passive side, and plenty of advisors specifically that had success using ETFs over the last decade, for their large cap allocations. Listen, they're cheaper than active. They worked, especially in this efficient market like large cap. What advice do you give an advisor who's maybe rethinking active and he's picking through a stable of potential managers? And if you could give your answer quickly.
There's 3 key factors I would tell advisors to focus on. One is active share. You want a differentiated performance experience versus the index. Owning a closet index manager here is not preferred or going to work, in my opinion. I would focus on managers that have active share of 70 or higher to get that differentiated performance. These are managers that have higher concentrated portfolios and higher focused portfolios. 2, I want to focus on turnover. I think it's an important corollary as well to getting the outperformance over the index over the long term. Turnover is key, low turnover is key. I would focus on managers that have lower turnover ratios over the long term of less than 50%. 3 fees matter. We know this. It's important to getting the net of fee performance over the long term. We've seen a tremendous amount of downward pressure on fees in the active space over the last 10 years. This should not deter an advisor from making an active allocation decision. The last point I want to make and I want to close on is there was a great research piece that came out from AMG over the last couple of weeks, and they talked about the level of outperformance independent active boutiques had over the passive index when looking at a study over the last 20 years, actually 3x higher than non-boutiques. So the key takeaway there is do your homework, focus on managers that have long-term track records, have proven skill in down markets, and find the managers that have outsized alpha. They may not be the brand names that you see and read about every day in the newspaper.
Matt, let me pivot to you here. Obviously, we're talking about doing your homework. We're talking about how managers are performing. Tell me what's made Westwood successful in previous downturns, and if there's anything that you're doing different during this down cycle, maybe compared to 2009, if you could.
Sure. I think first and foremost, our focus on the quality end of the spectrum. So we're buying businesses that generate strong free cash flow, that have returns on invested capital well in excess of their cost of capital, and have conservative balance sheets. But importantly, we're only buying these businesses when they're trading at a discount to intrinsic value. We're not quality at any price. We are trying to hit that intersection of quality and value, and that helps us limit the downside. It provides a margin of safety. I would say from a process standpoint, just briefly, what's different this time, we really take a concerted effort to remain consistent with our process. I would say we're pivoting a bit how we're analyzing certain risks in this unique environment. For example, in the consumer staples space, I spent a lot of time researching food companies historically You haven't wanted to be in the middle of the grocery store, the center of the store that's been a no growth area. You've wanted to be in the food service channel, the convenience store channel. But when you think about today's crisis, food service and convenience stores are feeling the most pressure, and you actually want to be in the center of the store. So we're making small tweaks like that to assessing characteristics of each company.
That's interesting. You know, a lot of folks, I feel, you know, I've been in this business 25 years professionally, and you know, it's kind of like the old tried and true stuff works. We want to deny it, but when you talked about, you know, quality, and you talked about, you know, focusing to areas that are the nuances, the small things, you know, I mean, those are the pieces of the puzzle I think sometimes go missing. And it's good to hear you say that. And I want to bring up something that Harvey mentioned earlier, and that's the fact that good managers will succeed here. What do you think makes a good manager? And on that, what is your team specifically doing to help ensure, you know, prospective investors keep active managers like you front of mind?
Sure, it's a good question. I guess I would say consistency is very important. Consistency in investment approach, consistency in philosophy, consistency in how you assess risk and reward, and not letting the current market environment affect how you manage risk. And I would say we, again, take a very concerted effort to keep consistent in our investment process and how we're analyzing risk and how we're vetting ideas, consistency in how we build portfolios. And that creates repeatable results over time with that process. It's not one person in a room making all the decisions. It's a repeatable, consistent process over time that delivers these sustainable results.
Matt, thank you so much. Phil, Harvey, great to be with you guys. I'm going to leave it there as we're running out of time. Guys, these sessions, we tape these live. We're trying to bring you as many as possible. And please stay tuned to our channel. And again, thanks for joining us. I'm Jared Levy.